Welcome to the Sykes & Company PA video blog.
Certain key performance indicators can be a good indicator of cash flow in a pharmacy, and others are not necessarily that. Now, one of the main items we're always looking at on the balance sheet is the current ratio. The current ratio is your cash, your receivables, your inventory divided by what your short-term payables and debt is to get a factor. Typically for a pharmacy, that's in the 2.5 to 3.5 range, meaning you've got $2.50 to $3.50 of cash, receivables, and inventory for every dollar of cash that you have. For every dollar of debt that you have that's owed in the next 12 months. So that's a really good indicator of what kind of cash flow that you have available. Now, with respect to purity cash-driven indicators from the P&L side that maybe transfers over to the balance sheet, obviously your gross margin, your sales less your cost of goods sold, less rebates, gives you a really good indication of what your gross margin is, which obviously is a huge cash indicator. What your salaries are and benefits and payroll taxes are is the second largest tranche of expenses, expenses out of purchasing items that will have an impact on your cash. And then obviously when you look at your bottom line number, we like to see 4 to 7% net income pre-tax as being kind of the general indicator of what the net income is for that business. Now, the net income within itself is not the indicator of what kind of cash flow that's been generated from operations, because you've got to take how the balance sheet items, whether it's inventory, receivables, payables, notes, how they ebb and flow during the course of the operating cycle, whether it's a month, whether it's a quarter, whether it's a year, and how all that operates together will determine what the net cash flow generation capability of that pharmacy is. You do want to keep your eye on what's happening at the operating level. You want to keep your eye on what's happening at what we refer to as the level where fixed assets are purchased, and then on the financial side, what debt is being repaid back, is paying back debt obviously gives you no tax deduction, but its use of cash and making any shareholder distributions is obviously a use of cash. So the net cash that you generate from operations, less the cash that you spend to buy for equipment or leasehold improvements, vehicles, robots, whatever the case is, less debt payments that you're making, less shareholder distributions, give you kind of the net cash increase or decrease, again, for that cycle, whether it's a year or whether it's for a month. So those are really good indicators to figure out what kind of cash flow, whether cash flow is positive or negative. And obviously it all kind of generates from the P&L. Balance sheet has impact, money coming in that you're borrowing, money that you're paying, receivables going up or down, inventory as it goes up and down. Just as an instance, if you take inventory and if you turn that once a month or 12 times a year, and you maybe use some of the cloud-based technology that's out there to increase it to 20 times a year, that's going to increase your cash flow. So there's a lot of things that you can do from your balance sheet to increase your cash flow during the course of the year that drive key performance indicators even higher, to give you a really good feel of what's taking place in that particular pharmacy. So there's not one key performance indicator. There are a multiplicity of indicators that all tie together, that all feed together to determine the amount of cash flow that pharmacy is generating. Well, in looking at these ratios, these key ratios, for example, that current ratio, if you're seeing that drop precipitously, then that's telling you that cash is maybe dissipating. And you have to ask the question, why is it dissipating? Is it because you're buying fixed assets, that you're paying down debt, that you're building inventory, that you're building receivables? So each element of the balance sheet affects the cash flow positively and negatively. And as these indicators go up or down, and obviously in that current ratio, you want it to be, 3 to 1 or higher, if at all possible. And if you see that dropping to 2 to 1 from 3 to 1, you know you've somehow utilized cash in a way that you need to make sure you understand why it was done. Otherwise, you may be totally out of control as far as what's taking place within your pharmacy. So again, it all goes back to having good, solid, fundamental accounting data, month in, month out, with everything on that balance sheet adjusted correctly. Because if that balance sheet is adjusted correctly, then your P&L is going to be accurate. And all these indicators and all these performance indicators that we're looking at are going to give you valid data that you can use to manage the pharmacy. Monthly, you would definitely want to be looking at these key performance indicators without question, monthly.
Thank you for watching. If you enjoyed the video, we invite you to subscribe to our YouTube channel.